Fintech Southers. I'm Jennifer Lucas. I'm with EY. I lead our payments practice here in the Americas, and I'm joined today with an esteemed panel to talk to you about what's going on in payments and payments innovation. I'm going to introduce very quickly Trey Loughran. He's with Purchasing Power, Lara Hodgson with Corp, and Piatt with Ondot. So these guys got very diverse business models playing different roles in the payments and commerce space. And we're going to talk about the hot topics in payments today. So Lara, I'd want to hand it to you for a quick intro and tell us a little bit about you and your firm.
Great. Yes. Hi, I'm Lara Hodgson. I'm a rocket scientist turned serial entrepreneur. And with my last business, I was growing my business quickly and it was taking forever to get paid. And I looked at all the options that were out there. I didn't want to borrow money. I didn't want a line of credit. I didn't want factoring. I didn't want anything that added a liability to my balance sheet. I just wanted to get paid faster so I could stop being the free bank to my customer. So I created Corp and our product Now Account, which is the first B2B payment system that allows small and mid-sized businesses to get paid immediately when they deliver their good or service in a way that feels like taking a credit card when no card is offered instead of using a line of credit or factoring. And I'm excited to be here. Trey, you want to tell us a little bit about yourself?
Sure. Thanks, Laura. My name is Trey Loughran. I am the CEO of Purchasing Power. Just passed my first year here at Purchasing Power and couldn't be happier to have been here despite a bit of a turbulent first year. So Purchasing Power is a really unique business model, unlike any I've seen before. We've been in business for 20 years. And, in short, we were kind of buy now, pay later before buy now, pay later was cool. 20 years ago, we started with a model and we've kept that model and continued to grow it over the last 20 years. We are a unique intersection of specialty finance, employee benefits, and e-commerce. We offer our own retail e-commerce platform that's offered directly to employees of large employers, typically well over 15,000 employees. And employees are able to come in and buy from us, but we finance the purchase up front. We give the customer the product and the customer pays us back over 12 months through payroll deduction, which provides a really unique avenue from a payment perspective, which I'm excited to talk about some more later. Great to be with you all. Randy?
Good afternoon, everybody. My name is Randy Piatt. I'm really excited to be here today, and I am the head of product solutions for Ondot Systems. We're based in Santa Clara, California, the heart of Silicon Valley. And what we do is we work with community and other issuers of all kinds to modernize their credit, debit, prepaid, all those cards on their existing card rails so that they can offer digital first card solutions that allow them to engage with their customers similar to the Apple Card, the pending Google Cash and all those kind of things. And so give them the ability to understand how they can use their card, how they can understand their purchases, how they can manage their preferences around that, and then certainly engage with the cardholder real time, enforce preferences, and deliver really rich information. We've been in business since 2011, and we serve over 4,500 institutions across the globe, including 2 global top 10s. And we work with issuers of all sizes and processors, and just really excited to be here today.
Great. Well, I really appreciate you guys coming. And, of course, this is a hot topic near and dear to my heart. Payments is my job. But it's the most fascinating topic, I think, in financial services. Really appreciate you spending the time here with us today. So, so you can't start talking about payments without talking about how COVID's thrown us a little curveball. Some people, it's like an accelerant. Some people have had, a little bit of a delay, but I'd really love to talk to you about how you think COVID's impacting payments and your business. So I'm going to start with Randy. You're on the consumer information side, card issuing side. You're probably seeing a shift in behavior. Tell us what you're seeing on the front lines.
Well, I think we're seeing some real acceleration. There were things going on before COVID started, and there were some surprising shifts in the middle of COVID. Certainly, we were seeing a ever-increasing shift to digital, people wanting to enact more on their phone, but there was still a little hesitancy, and people threw that right out the window in March and really decided, you know what, I'm not going to the movie theater anymore. I'm signing up for, streaming services. I'm not going to a restaurant anymore. I'm having my food delivered by Uber Eats and DoorDash and all those. Or I'm not going to the grocery store. I'm going to have Amazon or Carrot or whoever deliver my groceries to me. And what that has resulted in is a tremendous shift in what we call the card present versus card not present transaction mix. And so a card present transaction is I'm using my physical card or my mobile device to make a purchase at the merchant versus card not present, which means I'm shopping online or in an app or any of those kind of things. And, at the end of 2019, the card not present, the e-commerce side was 15% of overall retail spend. And that number had increased about a 1% absolute value for a decade. In 2020, we are seeing that move 10 percentage points, a full decade of change in less than 6 months. And so it really is shifting the view around that. And for institutions that we serve, it really is about this evolving definition of service. What does it mean if I've made my bones as a bank or a credit union off of that face-to-face service for 2-3 decades, and now overnight, my branches are closed. I'm in drive-through only. If I have appointments, I can only have one member or customer in the market, and so in the branch at one time. And so there's just a tremendous amount of shift there. And the real question is, how many of these things are going to stick? And I think we have seen, as a result, institutions have really fallen into two buckets: the digital haves and the digital have-nots. And the folks that had already kind of thought through and articulated a digital strategy are really just haven't looked back. They're running away with it. And you can see it with the big banks and the new accounts they gathered in the second quarter. 51% of the new accounts in the second quarter went to Chase, Wells, and B of A. Just unreal.
Yeah, I mean, I'll tell you, like I've had a friend that works at a financial institution. They were able to get 2 years worth of work in the digital space done in 4 months, which is, agile acceleration is great. Hey, Lara, I wanted to get to you because, payments is all about commerce, and you're in the commerce business, right? You're about enabling cash flow and commerce. Talk a little bit to me about how COVID's impacted what you're seeing and what you're doing.
Yeah. So it was interesting. When COVID first hit, we were inundated with small and mid-sized businesses scrambling to find solutions that would help them drive an increase in liquidity so that they could survive this craziness. And we were a little hesitant at first because we weren't quite sure if COVID was going to cause their customers to take 10 more days to pay or 30 more days to pay. And so we really kind of took an approach to watch it very carefully. And I will say in a very positive way, we have seen no increase in write-offs. We have seen a slight increase in the amount of days it takes for people to pay their invoices, but not a lot. And that's a huge credit to my team that has continued to manage that very well. But I'll tell you what I think the biggest thing that was illuminated by COVID was, and it's a huge opportunity in the payment space, and it's about supply chain. So when you think about what COVID did, it blew apart most of our supply chains. And the one that we're all very knowledgeable about is toilet paper, right? For whatever reason, when COVID hit, you could not find toilet paper on the aisle of any shelf. And really, why is that? Because COVID did not drive this huge increase in use of toilet paper, nor did it shut down production of toilet paper. So it wasn't a demand issue and it wasn't a supply issue. What it did is it made the supply chain no longer match. And so there was plenty of toilet paper out there, but it was boxed in massive bulk shipments ready to go to office buildings that no longer had people in them anymore. And you can't put that box on the shelf of Harris Teeter or Kroger. So what it illuminated is what the natural supply chain was. Capital has a supply chain. And what COVID did is it showed us the real supply chain of capital into and through small and mid-sized businesses. When the PPP program started and the government said, we've got to get capital in the hands of small businesses, they said, let's send it through the normal supply chain, which was financial institutions. Look what happened. It didn't go where they thought it was going to go. It went to larger businesses. Did the banks do anything wrong? No. The banks did what they always did. But what it illuminated is that they don't serve small businesses well. The natural supply chain of capital into and through a small business is not through a financing tool, it's through commerce. Most businesses get their cash by selling goods and services. They get it through revenue. And I think what that shows us is there's a huge opportunity for fintech and primarily payments companies to really figure out how to facilitate the flow of revenue in commerce, which is a much better way to fund a business than through financing, loans, et cetera.
Great example. I love the analogy. So thank you for that. All right, Trey, you're in a totally different business model. You're bringing retail commerce to the payroll sector. Talk to us a little bit about what you've seen there, that from a COVID perspective, if anything.
Yeah, well, there was obviously a lot of implications when COVID hit for our business, including the supply chain, obviously, which interestingly, we didn't see much disruption in our own supply chain from a merchant standpoint, although our big time is about to hit, and it's going to be really interesting to see what happens in the fourth quarter. But we're not talking about the merchant supply chain in this case. We have a really unique advantage, and by serving customers of large employers who typically are about a 550 FICO and are in need of certain things, call it a new computer, call it a new refrigerator, a new sofa, we allow them to purchase from us with no credit check. And we use some pretty general criteria on a client-by-client basis, looking at tenure and salary, and then we set spending limits for our employees. Our risk has always been, if somebody's employed, we're going to get paid. They're not going to go turn off, knock on wood, they're not going to go turn off their payroll deduction. So our risk has always been employment. And even back in 2008, we weathered the storm pretty well and didn't see massive changes in unemployment. Obviously, when COVID hit and we started seeing a very high level of unpredictable risk, we didn't know what to expect. We didn't know if 30% of our workforce is going to be unemployed, and if so, whether we're going to have to go find a way to collect from them. Because when somebody does quit paying us through payroll deduction, we've got to go figure out, we have our own collections team that goes to collect from them. So what it forced us to do is, with a very high level of uncertainty at that time, to really be a lot more aggressive in risk mitigation measures than we would have been in the past, and looking a lot more at client by client, what the risk of those clients were, and where we wanted to change spending limits of consumers, employees, or where we wanted to pull back on marketing or cut off marketing altogether to certain employers. We didn't really shut off any employers, but we had some risk. And some of our large employers are going to be people you are very familiar with, that you hear in the news every day about employment challenges. But really, fortunately, we have a very high concentration of customers in areas like government and healthcare. I kind of call good retail. And so we've seen our customer base hold up really, really well. To give you a sense of that, before COVID, at any point in time, probably 5% of our customer base would be considered in a terminated or a leave of absence status. That got up to about 9.5%. So it about doubled, but it didn't go to 20%. And so it was a very manageable amount that we could manage, but it did really force us to be a lot more nimble, meeting daily, looking at every single client, figuring out how we were going to manage the risk on those clients. And, not a muscle we really had to flex that much in the past.
Sure. Well, that's helpful. So I'm going to stay with you, Trey, just because we're talking about buy now, pay later concepts. And, the digital side, we talked about COVID being the, gas on the fire in a good way. We're seeing a whole lot of buy now, pay later in the consumer space. Point of sale financing is nothing new. We've had it for decades. You've been at this for decades, but we're seeing the kind of fintechs coming in and offering installment loans, paying out, buy now, pay later. What do you think is driving that, and what do you see going on in this trend?
Yeah, well, if you look at the survey data, there are really three things that are driving it. People's use of buy now, pay later. One is that they don't want to pay credit card interest. They don't want to pay interest at all, but don't want to pay credit card interest. And a lot of times the folks doing this might have very high credit card interest. The second thing is they're using it to buy things that they might not normally buy. We don't actually think it's the case with purchasing power, but buy now, pay later in general. They're saying, hey, I can buy this. I don't need I normally couldn't afford to buy it. And the third is they want to avoid having a credit check. And so those are the three reasons primarily why people use buy now, pay later. The the interesting model is, to what extent are we going to see people really start to get overextended as this gets offered more and more in various places? Because you're seeing it, become much more of a standard through e-commerce or through digital means. It's going to be a lot easier at a point of sale now to be able to sign up for it with no interest and to be able to get that, short-term loan. It is challenging for people to really understand what they're signing up for and what the impact is. And if they get extended beyond that, they're going to have very high interest rates. So, as we see it go more and more mainstream, and just read the other day that I think Klarna and Macy's did a deal together, it's going to come under more and more of a regulatory microscope as well. When somebody buys from us, we give them a whole TILA online. They get their entire, and then we send it to them right afterwards. And it's very, very clear. And we are the merchant of record in that case. We're selling the product, whereas these other arms are really financing. So I think you're going to see a lot of regulation, but that's what people are looking for. They're looking for, ease, simplicity, being able to buy things that they weren't going to be able to buy before. But it's becoming, I think it's going to become, for a lot of millennials in particular, a real substitute for credit cards in a lot of cases.
Yeah, I agree. It's almost frictionless, like you forget about it, right? It's too easy that you almost forget about it. Hey, Lara, so you're in the B2B space and, payables and receivables and talking about getting paid. We had people with COVID and, that couldn't get into the office to deposit checks and write checks and deal with the invoices. Talk about the digital acceleration in B2B in the payables and receivables space.
Yeah, so it's interesting when I hear Trey talk about buy now, pay later. That may be the one area that B2B leads B2C. Our B2B is all buy now, pay later. That's actually the problem. Yeah. That's what causes trade credit to be a drag on the U.S. economy. But I think really where we're seeing, the evolution of B2B does typically kind of follow B2C. Right now there's been a huge proliferation in the automation of accounts payable. There's been a proliferation in the automation of accounts receivable. Recently, there's been a lot of folks pretty industry aligned trying to kind of create the whole procure to payment closed loop system. And I think what's going to happen, just like what happened in the B2C side, is you're going to have, this sort of industry aligned proliferation of these portals, these, procure to pay systems. And then ultimately there will be consolidation, right? There will be, some of these groups will come together and we'll end up with the 3 or 4 that become kind of the at scale default systems that people use to manage accounts payable, accounts receivable, procurement, et cetera. And I think what we're starting to see, I know for us, we are getting lots of calls today from all of those platforms saying, look, we can process accounts payable, we can process accounts receivable, we can't accelerate it. Because to do that, you need a balance sheet. And most technology platforms don't want the balance sheet or the risk or anything like that. And Now Account has access to the largest balance sheet, which is the capital markets. So we have been looking at a lot of those folks on how we can kind of build our payment system into their platform. And that's where I think the platforms are going to start to look, is how do they accelerate payments and partner with balance sheets that can do that.
You're seeing a lot of that in the buy now, pay later space in the consumer side, where they're partnering with, issuing institutions that will hold that balance sheet, because those finance companies don't want to be regulated in the same way that a traditional institution. And so it's created this very unique situation where a customer can complete a purchase of a couch all the way down to a toaster and do it directly onto a lending instrument without having to use a card at all. Yeah. And so for the issuers that we work with, it actually has the net effect of taking transaction volume away from them, because their card is no longer top of wallet for those types of transactions. And so they're really trying to think through, how do I drive affinity for the cards and the offerings that I have as an institution, so that I can offer maybe similar products, but give them a reason why they should use their credit or debit card that they have with my institution. And do I have a digital experience that helps them understand their spend, control their spend, all those things. And at the same time, they're competing against, Apple's credit card. Google's about to come out with their new checking account that has a smart debit card and all that stuff. And these are digital only experiences where the card is optional. And so it really is delivering on that paradigm that we're seeing B2C and B2B. And I think it's very compelling. And I think we're seeing long-term habit changes in consumers as a result, where they went from overnight wanting to do this stuff in person to now everything is on my device. I want to do this all on my phone. And we've learned, I think MasterCard said 18 months ago, 87% of people are never more than 3 feet away from their phone. They said 50% of millennials sleep with their phone. And so it's an extension of who they are. And so the more that you can enable that digital experience, it becomes the most valuable piece of real estate that any business has, financial institution or otherwise, has with that customer.
It'll be interesting to see how much some of those folks that you've talked about are able to kind of thread that needle between lending and being the merchant in those cases, right? Because historically with buy now, pay later, I mean, if you go all the way back to the general store, right?
The merchant
it was the merchant of record, right?
Yep.
And so the merchant of record was the one giving you the terms. And so therefore, it was clear, you were paying them back through an installment plan. And, that's, for example, what we do. We're the merchant of record and we're getting paid back through an installment agreement over equal payments. But as people are walking the line between the merchant and the financial institution, I think it'll be interesting to see, and I think we're already seeing this in certain states, some scrutiny of those models to say, hey, do they need to be regulated like a lender or not?
Yeah, and because they don't have to, many of those merchants are like, oh, this is awesome. You're going to take on all the risk for me in the purchase. And I don't have to worry about that. I get paid 100% of the purchase price. I may have to pay you a merchant discount fee of some kind, but I'm still made whole on my purchase. And you're going to manage the risk. What's not to love? And so I think that's really in that merchant space.
That's what our clients say.
Yeah. So I think it's a compelling shift, and we're in for some roller coaster times. Please hold on to the bar. So.
That's why we love our jobs and our careers. Hey, so I want to go to what some people will call the new oil. I'm just using air quotes. I'm not a consultant, but I don't have a slide that says data is the new oil, but data is really what people are after, and really is what is enabling a lot of frictionless commerce activities. So Laura, I wanted to go to you and talk to you a little bit about how data is helping the AP/AR space, which you mentioned before, and how it can help on the cost of capital.
Yeah. I mean, really, it's funny. It's just like when small businesses say, I need capital. My answer is always, no, you don't. You need to do something, and capital is the way to do it, right? So capital is never your goal, but it's the means to doing what you want, which is get that big customer, et cetera. Data is very similar. So when people say, oh, data's great, well, not really, unless it helps you do something. And so for us in the B2B space, data really is about mitigating risk and mitigating the cost of capital, right? Those are the two things that affect the economics. And so the purpose of data, now obviously there's other purposes from sales and marketing and revenue growth, but for us, the real use of data is to make better credit decisions, better underwriting decisions, so that we can box in that risk. And if we can do that, then our access to capital comes at a lower cost, right? And I think that is going to be exponentially more important as we come out the back end of COVID, which we know is a marathon, not a sprint. But the reality is, when COVID hit, it took out probably the most, the weaker of companies. But it's like a hurricane. There's an eye and there's going to be a back wall. And that back wall is going to be something Trey alluded to earlier, which is there is going to be a huge constriction in credit when we start to see losses. And when that credit constricts, on one hand, that's a massive opportunity for the fintech world to step in, but not if their cost of capital is too high. So I think there's going to be some real innovations around data as it pertains to boxing in risk, quantifying risk, so that we can manage the cost of capital in a way that allows us to serve those businesses.
Because delinquencies have been dropping like crazy, on consumer, at least on consumer finance, and that's because people have been giving accommodation for loans, loan accommodations, et cetera. But I mean, if you listen to ratings agencies, they're still just waiting for that shoe to drop at some point. Now, maybe it never will. Maybe the government will carry everyone through. But you got to believe at some point the shoe's going to drop on that, because delinquencies, are much better than they were a year ago.
Yeah. Well, and I think on the B2B side, Trey, everyone has rushed, rightfully so, to grab access to whatever capital they have to build liquidity so they can navigate this. But there's going to be a lot of businesses that make it through COVID and put way too much debt on their balance sheet, and they're going to die from the overload of debt than they are from COVID. So yep. I agree.
Hey, Randy, you're in the data business. I mean, you're in the middle of that auth stream. You're dealing with card controls. You're dealing with a number of different features and functions in the point of sale experience in real time. Can you talk to us about how data is and will be extremely important to not only your business but the companies that you support?
Yeah, there's whole industries are built around financial services that deal with using data. Look at the fraud, the Falcons of the world that do the real-time fraud, neural networks and all those fun things. And what we've learned is that a lot of times, even with all that power, those neural networks and all those things still are going to give you false declines and all those kind of things. And so what we focused on here at Ondot is seeing those transactions. Why not just get the perspective of the customer? They're going to tell you how they're using the card. And by telling you how they're going to use the card, they're also telling you how they're not using the card, the photo negative, if you will, of that conversation. And by doing that, that's really in 2014, when we came in the market, those controls are simply me saying, I have these preferences. And because I express these preferences, I can now decline those transactions that fit outside of that preference profile. But then we've learned that actually over time, there's still an area of some bogeys, if you will, to fight there. And it's dealing with the efficiency ratio of the institutions because they have high write-offs still for fraud. They have high write-offs for disputes. They have OpEx costs for running their call centers. And so you can do the simple things like enabling self-service journeys. But what we're doing now is actually enriching the purchase transaction real time, cleaning up that transaction description. And I look to all of you and say, I'm sure you can remember a time where you've made a purchase and you see it in your online banking or your statement, and you're going, what in the heck is this purchase? I have no idea. And if you could look in your mobile app or call your bank or credit union and go, what's this purchase from Randy LLC? And they could quickly tell you, oh, that's a Dairy Queen. Oh, okay, we went there for dessert the other night. And instead of writing off that transaction because it's probably under that $25 threshold, we're able to use that information to give them that. And we've saved the phone call or minimally reduced it. We've saved the dispute costs. And now we're able to save the write-offs as a result. And so by enriching that, we're able to control a lot of those costs. And then I think the third way, so we started out, what do the transactions look like? How are we helping them identify to reduce write-offs? The third way is, how do we give them insights into what they're spending on so that they can say, I'm going to reach for my credit union card over some other card in their wallet. And this is the battle that institutions are fighting. There's data came out, I think it was payments.com. Literally a third of the country has at least 2 checking accounts. And so that leaves institutions going, am I the primary or am I the secondary? And how do I know which one I am? And so how do I drive that affinity so that they're reaching for my debit card or my credit card versus some other card in their wallet? And so that data helps us continue to evolve that experience to drive up that spend, because all of it leads to transaction volumes, which means transaction revenue and interchange for those institutions.
Very helpful. So, I mean, we talked a little bit, Lara, we talked a little bit about data and how that helps you reduce the risk of capital. And we want to get to risk, because you can't talk about payments without risk, without not being real. So I wanted to talk about in the B2B space, that's where you rob banks because that's where the money is. Fraudsters go after the B2B payment space because that's where the large value payments are. So tell me a little bit about what you're seeing in that space and what you're looking forward to possibly thwarting some of that fraud.
Yeah, I mean, we've definitely seen in the last couple of years, and certainly during COVID, with people being remote, there's been a large increase in what's called business email compromise. And an example would be a client of ours delivers a good service. They send an invoice to the customer. A fraudster gets into their email box and sees that they have a customer that is Coca-Cola, and they reach out to accounts payable and say, hey, my remittance address has changed, so remit to this B of A account instead of this other one. And before you know it, the the obligor has paid the wrong party, they've paid the fraudster. At that point, there's still not a lot of case history that would determine who's at fault, right? Because is it the person whose email was compromised, or is it the person who paid the wrong party? And there's cases in both cases, but we're certainly seeing that a benefit that our clients have is that if they use Now Account, they're much less likely to be victimized by that, because the remittance all goes to an assignee. So, but we're certainly seeing a large increase in that. And that's the stuff you don't see. I mean, everybody hears when the Fortune 50 company gets hacked, but the largest dollars that are stolen from American businesses are not the big hacks. It's these little 100,000, 500,000, 40,000 that's siphoned out of small businesses. Last year, there was more loss from that than fire. And so, people don't notice it because it's death by 1,000 cuts. But you're right. People don't think you're too small to be a victim, because that's exactly where they're looking, as small businesses and their customers.
Yeah, I mean, it's devastating to them too, because they're much smaller.
Sure.
Randy, I mean, I know risk is part of your, Trey, I know risk is a big part of your business model and managing that. Can you talk about what's going on in that space, or things you're optimistic about, and how to manage risk on a go-forward basis?
Yeah, so we have there's probably four key places where we have to manage risk. One is when we sign up a customer and a client, and that's basically in terms of, how we set the thresholds for what they can buy and kind of what we're willing to advance to them at the beginning. So that's kind of a credit risk view. And then, we get to kind of fraud risk, which happens both when somebody signs up as an employee and registers on the site, and then each time they purchase. From a fraud standpoint, we're watching that. And then the last area of risk is that, which is actually what we were talking about earlier with COVID, which is where we see unemployment happen and we have to go collect from that customer. And that's where, going back to what Randy was talking about, that's where, while we don't take a card for purchase, we are taking cards for backup payment. And in the past, it has not been a really big area of focus for us. It wasn't a big deal. Our loss rates for 19 years where you could bet on them and make be very comfortable in what you're betting. And over the last year and a half, even before COVID, we saw a little bit of change in those loss rates and had to kind of get smarter about what we're doing. And luckily, we'd already gotten smarter about it when COVID hit. But so each one of those areas has their own unique challenges. But what I will say is that particularly from the fraud standpoint, we've implemented a lot of new changes from fraud. We've implemented a new card vendor that's helping us provide a lot more data, to your question earlier, about what the turn down rates are and why they're occurring, and it gives us a lot better view of that. And overall, we've seen, particularly with fraud, a much better performance actually throughout COVID, and not a big spike in fraud, knock on wood, and have been able to manage it a lot more closely. On the back end, we've just had to get a lot smarter about how we're looking at what we're doing on the front end and what we're doing to minimize risk in the front end when we get to the collection side on the back end. And that's still a work in progress to it. But, again, it's forced us to have to be a lot better
Sure.
than we normally would have been.
Discipline, yeah. And Randy, 2 minutes on this, and then I want to get to our speed round of predictions. But Randy, you're in the business for risk. Card controls was like, turning on and off your debit. It's kind of one of the biggest features that you guys started out with, but I know it's grown from there. Can you just talk about what you're seeing in that space? Engagement opportunities, how you're partnering with banks to really thwart some of the fraud that you're seeing in the space?
Yeah, I might actually say we're more in the engagement business than the risk business, but
okay, I concede. Okay.
Yeah, absolutely. But where we're seeing a lot of insight is to taking this voluminous transaction data and figuring out what that means from driving certainly campaigns and getting to the right person for marketing and those kind of things. But we have others, when you look at things like our location ability, the ability to tie a card present transaction, a physical card transaction, to the location of that mobile device. And so as I sit here today in Columbus, Ohio, and a physical card transactions attempted there in Atlanta, it's going to decline because it knows that I'm here. And so we're able to use the biometrics and other capabilities of the device to say, I know Randy is not in Atlanta. And so we're able to do that. And so we're able to drive some real-time effect on that. And the customer can control that. Not just the location of the device, but maybe I can expand it out and say, here's the whole Columbus, Ohio metropolitan area, and I want my card to work here, not necessarily if my device is with me or not, and still be able to contract that write-off related to the fraud risk.
Interesting. So I have had that problem before where my phone was in one location, my card wasn't, and it didn't work. So I'm going to blame you.
I can recommend a couple of institutions you might want to move your accounts to.
I'm kidding. Okay, so we've gone through a discussion on payments. I just want to highlight that we did not say many of the buzzwords that you would have. There's certainly real-time payments. There's cryptocurrency. There's blockchain. There's telepathic payments. I'm making that up, but there's a lot of things going on in the industry that we didn't talk about, but I'm really glad that we spent our time talking about the experiences and the kind of the subject matter, deep subject matter aspects of your businesses and how we're seeing that play out. So that's extremely valuable here. So we're going to go to our lightning round. We have 4 minutes. I really want to talk about predictions, what you see in the future, or you can talk about what you're seeing in the future, what you're most optimistic about, or what you think is going to stick the most post-COVID. So I'm going to start with Lara.
All right. Well, so my prediction is sort of back to the future. If you think about it 50 years ago, as Trey alluded to in one of his comments, retailers waited to get paid because there were no credit cards. So they extended credit to their customers. They were essentially the lender. And the credit card system created a wholesale shift of that consumer credit off the balance sheets of merchants and put it into the capital markets. And obviously that was the catalyst for huge amounts of innovations in the B2C payment space. I think the same thing is happening in B2B. I think that as we've gone through COVID and businesses that traditionally turned to debt structures, et cetera, are realizing they don't want to be the free bank to customers. They don't want more debt on their balance sheet. They just want to get paid immediately. And there's going to be a same shift of taking that B2B trade credit off the balance sheets of small business merchants and putting it in the capital markets.
Very good. Exciting times. Trey, how about you?
I got 2 that I would raise. I think we're going to see a significant increasing number of companies out there trying to get to, what for at least us is kind of the holy grail of payments and a payment mechanism, which, people don't really talk about that much, and that's through payroll deduction. It is a very secure and very reliable means of people getting paid. And the reason people haven't done that is because it's really, really, really hard. We've been doing it for 20 years, and trying to navigate payroll systems and work through third parties like benefits providers is very difficult. But increasingly people are going to be investing in technology to try to make that easier and trying to go down the payroll deduction path. The second area, which I don't know as much about, but is fascinating to me, and I've been spending some time looking at it, is cracking the nut of a problem between payments, increasing in consumerization of healthcare, between the payer, the provider, and the consumer. Because as consumers take on more and more of that burden, there's got to be easier ways that they can pay for this. And a lot of what we've talked about today is going to continue to show up in that environment, and is a great opportunity to help solve some really big problems that exist in that payment structure.
Yeah, I'm very optimistic about that too, Trey. There is a miracle cure out there somewhere. All right, Randy, how about you?
Absolutely. I would have 2
minute.
One on the issuer side, one on the consumer side. And as we have experienced multiple times in our history, every time there's one of these seismic kind of tectonic plate collisions in the market, how do people react and how do they change? On the consumer side, we're going to see increased adoption of digital. They're already saying that they believe digital mobile payments, contactless payments are the safest way to pay. We have a coin shortage here going on in the US today because people don't want to touch cash because the CDC and the World Health Organization told them don't use it. And so we're now seeing that. And so you're going to see, I think, continued adoption of that. I think you've created, though, the existential question on the issuer side of, am I going to be in business in 5 years? because I have to understand if I'm going to move with these customer shifts, am I able to get to the digital servicing needs that my customers are demanding, and can I move quick enough to do it? And so I think you're going to see the cream of the crop kind of bubble up to the top, and you are going to see issuers kind of go by the wayside and get acquired, and lots more consolidation. I think you'll see actually another wave of consolidation in the credit union and bank space as a result of COVID.
Well, I cannot tell you how riveting this was. It was really quick. It was great. You guys are coming at it from different angles. It's a fascinating topic. Really appreciate your contributions to FinTech South. Thank you for having us. And, we've got our information available if you ever want to reach out and learn more about our businesses. So thank you so much. Thanks for FinTech South for having us. Have a good day.
Have a great day, everyone.
Take care.